Alright guys, we got a banger here for you in this video. We need to go over exactly what to expect next week, and I do apologize for a little bit of an echo. I did have to relocate due to a crazy windstorm here in Michigan with 70-mile-per-hour winds, something out of a movie. It sounded like a tornado was going down the street in about a 20-minute time span. Everybody lost power, internet out, so I had to relocate about an hour away, and I guess it shows the dedication we have here on this channel. But there's a lot to go over, what to expect next week, and really why the markets rallied on Friday and why AMC dropped. And that's really what I want to talk about. You guys will get a ton of value out of this video. If you do, hit that like button for me, consider subscribing to the channel, and check out the links down below in the description. If you guys want to join a non-payment for order using brokerage, check out the link for public. Very easy to sign up. You get a free share, I get a free share. You help support the channel and make all this possible. Love and appreciate you guys. Thank you for watching. Now let's get straight into it. So AMC did close down regular trading down 6.86%, and after hours down 0.44%. So it was not a great day. A lot of other stocks took a hit, but not quite as much as we have seen over the past couple of weeks. Whereas AMC would be down 5%, a lot of other stocks would be down at least 5%, at least a lot of stocks that I personally own. We kind of seen that divergence of a lot more selling of AMC, I should say. And if you didn't see the last video, that was institutional investors that were selling out, that was causing this selling power to hit the marketplace. It was not apes selling out of their shares, so forget whatever FUD videos you guys have seen. It was institutional investors that were selling out. But on top of that, let's circle back. Let's not get too off track here. What really caused the rally in the marketplace was due to the inflation numbers, which came out at 6.8% year over year. And this was widely expected. The range was in between 6.5 and 6.9%. We came in at the higher end range, but 1 point under our max range. So if we would have hit over 7%, we likely would have seen a sell-off. But the fact that this was widely priced in to be in between this very high range, levels we have not seen since 1982, that's the reason the market did actually rally. But all eyes are going to be on the Fed heading into next week, and that's really what I want to prepare you guys for. And due to the fact that we did get these high inflation numbers, 6.8%, that is very, very high. And just to put this into context, the last time we seen inflation this high, like I said, 1982, and the inflation rate, excuse me, was peaked out at 15%. Well, what happened with interest rates at this time? They went all the way up to about 20% to control inflation. So Fed Jerome Powell, he's widely expected to announce faster tapering, as fast as 2 to 3 times as fast. And I think the markets have widely priced that in. What the markets have not priced in is faster rate hike increases. And the fact that we have printed all of this money, and the fact that we are seeing inflation coming out this strong, that is no longer transitory, in Fed Jerome Powell's words, you're going to see faster interest rate increases. Now, if he sets a plan in place to, say, raise interest rates by 0.25% throughout all of 2021, by the end of 2021, we're at 1%, basically the Fed's funds rate, then you're going to look at some sell-offs in the marketplace. I think that's going to spook a lot of investors, because if you guys are really unaware of this situation, high inflation acts as 2 negative catalysts to the marketplace. Basically, if you're projected to earn set amount of dollars, say 5 years from now, but inflation's 5 or 10% every single year, that, say, $5 billion or whatever the magical random number is going to be worth a hell of a lot less once you get 5 years down the line. That $5 billion is only going to control, what, $4.5 billion of actual buying power 5 years down the line. So hopefully that makes some sense. It makes your revenue worth less. On top of that, if you're a growth company that has to raise money, you now have to pay a higher interest rate to raise that capital, which is obviously, goes without saying, it hurts the business more than when the Fed's funds rate is at 0% or damn near 0%. So that is the situation. That is how inflation hurts really growth stocks. A lot of stocks that don't have to raise money, your Dow Jones stocks, will do just fine. And you will see a rush back into those stocks. But like we went over on the last video, a lot of money is piling into these safe but high growth stocks. Your Apple, Google, Nvidia, Tesla, Amazon, all of these stocks everybody wants to own, but they're still growth stocks and they could take a hit, and they control about 20% of the overall market. So if you see people sell out of these big names and go into your Dow Jones stocks, you're going to see a major downturn in the marketplace. And that's really what I'm expecting around the Fed meeting. Now, we could see a bounce in AMC, and I'm really expecting a bounce in the AMC and the overall markets coming on Monday and possibly even Tuesday, heading into the Fed meeting the 14th and the 15th, which is Tuesday, the meeting, and then Fed Jerome Powell will be speaking on the 15th, and that is on Wednesday. Everybody will be all eyes on this, and you will see a big market reaction once that actually does happen. So that is the situation. That's really what I expect. A bounce to the first start of the week, and then to probably see a sell-off after that. I think Fed Jerome Powell has no choice but to raise interest rates and to become very hawkish. And he actually did this in 2018 and 2019 with all of these interest rate increases. I'll zoom this in so you guys can exactly see this, but he was raising interest rates pretty much the whole year, starting in 2017 all the way 2018 and even through 2019 before he started to cut rapidly. At about the July meeting, he started to cut, and September, October, November all started to cut, and then February 2020 he actually raised just a little bit, and then that's when the pandemic happened and we went to virtually zero. So he has no choice here. His hand is basically prove, he has to. There's no other way to put that. So it's all about how we are going to react and how you are going to react. I do think AMC could take a hit after this, the end of the week. That's really what I expect, just because they are a part of that sector that is going to be heavily shorted if Fed Jerome Powell, and I shouldn't even say if, I think it's almost a guarantee, but if he does announce faster interest rate increases. Now, let's get back into the data around AMC, because we are severely oversold at the current moment. We are, even on the MACD, you guys can see it's bullish when this yellow line, this CCC line, crosses above this blue line, the signal line. You guys can see right here, we started this rally as soon as the CCC line crossed above this, and then continued back here to about $46, come back down, and then you go bearish once the CCC line, the yellow line, goes under the blue line. And that's exactly where we are at right now. I want to see to indicate the possible reversal of the CCC line to go above the blue line. It's not as important as watching support, resistance, moving averages, and the volume, but still, nevertheless, something that I did want to put here in this video. And I actually, for whatever reason, got to redo the moving averages real quick, so bear with me, and then we'll take a look at that. Now, as far as the moving averages and support, let's talk support first. You're going to see support like we are currently seeing at about $26.50 per share, and then under that at about $20 per share. A lot of people are talking about we have a gap to fill down to about $17 per share, and that is true. That's going to be your lower end support level, but I do think $20 is going to be a lot more support than $17. But to be quite honest with you guys, I would love to see the markets push AMC down to $15, $10 per share. I would buy so much more AMC on top of what I am already buying. If I can get another 50% discount, I am going to go hella shopping. I'm going to break the bank, use whatever I can to buy as many shares as possible. So that's really what I'm expecting for the downside. I don't think we're going to go down to those levels, but that is your worst case scenario. As far as really what I expect to happen with the whole Fed, interest rates, all that, I think $20 is definitely not out of the park. And to see AMC go down another $7.44 per share from where we are currently at, you're going to expect the markets to come down as well. Like we talked about in the last video, that liquidity will be severely crunched. Now, let's get into the Ortex data, because we still are at almost record high short interest estimates at 18.63%. We all know the short interest is going to come in well over 20%. That is widely expected from me and hopefully from all of you guys as well. Shares that are currently sold short of 95.54 million. These are only estimates. The real number, well over 100 million. And like I've said for a very long time, I think the real short interest, if you include the shorts that are using the option chain to make it look like they have covered, I think it's in between 40 and 80% easily all day. That's what I've said for months now. So if you watch this channel, that has remained consistent. I don't think shorts have covered like at all. There's much more shorts that take on short positions than the small ones that do end up covering due to their liquidity needs or their margin calls, whatever. Every hedge fund's going to be a little bit different. Now, share utilization is 77.57%. That's a given. It's not really moved around too much. Days to cover, that's the most important factor here. Back November 30th, we had 3.12 days to cover. That is extremely high. That is the most bullish thing that is going in our favor right now. This means that it's very hard for shorts at the current moment to all get out of their positions if we did see that squeeze. And that's exactly what we've seen back here in January and back here in June. We need to see days to cover at these high levels, which they are at. We won't see days to cover actually come down too much until we do see that volume head back into the stock. And really what I want to see is obviously that bullish volume head into the stock after the Fed meeting. Once the markets come down, hedge funds have their liquidity crunched and they have to break the piggy bank per se, take their margin or their collateral out of their AMC loans to fund their other stock portfolio actions or moves, whatever you want to call it. So that is the situation. That's really what I expect. Hopefully I did a good job breaking it down for you guys. It's been a very, very stressful day. So hit that like button for me. Consider subscribing to the channel. I do apologize, like I said, for the slight echo as well as the change of scenery. That is going to be all for this video. Love and appreciate you guys. Thank you for watching. I will see you in the next one.